Hedge funds recently filed a list of their second quarter stock market positions to the SEC, and the filing for Ray Dalio's hedge fund, Bridgewater Associates, which is the largest hedge fund in the world, had some major surprises that are potentially a bad sign for Chinese stocks like Alibaba. Ray Dalio has traditionally been one of the biggest bulls on Wall Street for Chinese stocks. Just last November, he even launched a fund for Chinese investors and collected an equivalent of $1.25 billion from these investors, which was even larger than a rival offering from BlackRock, which is the world's largest asset manager. But the latest SEC filing for Ray Dalio's hedge fund revealed that they had completely sold all of their shares in Alibaba, JD.com, Bilibili, DiDi, and many other Chinese tech stocks. This is a huge deal because Ray Dalio has traditionally been a huge Alibaba stock bull and had been buying shares in the company as recently as the first quarter of 2022, before promptly selling all of his nearly 7.5 million shares just now in the second quarter of 2022. While we don't know exactly why Ray Dalio sold his stake in Alibaba, since the reasoning doesn't have to be disclosed to the SEC, there are several bad developments that have been taking place with Chinese tech stocks that may have been reasons for why Ray Dalio sold all of his Alibaba stock. In this video, we'll be taking a look at some negative developments that have happened surrounding Chinese tech stocks to get a better picture of why Ray Dalio might have sold his stake in Alibaba. The first major development that's been occurring in recent months is the heightened possibility that Chinese stocks could be delisted from American stock exchanges. Congress recently passed the Holding Foreign Companies Accountable Act at the end of 2020, which requires the auditors for Chinese companies listed on American stock exchanges to share information with American inspectors, or they will be delisted from American stock exchanges. The Chinese government has never allowed access to see and inspect information for these Chinese companies that are publicly listed. But the United States is now forcing the issue that these Chinese companies must comply with the inspection standards that other publicly traded companies do. The act is currently requiring all Chinese companies to comply by 2024, or they will be delisted from American stock exchanges. This is a big deal because if the Chinese government prevents these companies from sharing information with U.S. regulators, these Chinese stocks will be delisted from U.S. stock exchanges. When a stock is delisted from American stock exchanges, the stock most often continues to trade as an over-the-counter stock. But there's much less liquidity in the over-the-counter markets, and not every investor wants to own or even has access to over-the-counter stocks. So if Alibaba and other Chinese stocks were to be delisted, their stock price would likely fall heavily, as a lot of American investors would exit once it became an over-the-counter stock. To make matters even more pressing with the Chinese stock delisting risk, 5 Chinese state-owned companies announced just a few weeks ago that they would be voluntarily delisting their stocks from the New York Stock Exchange. These included the oil giant Sinopec, China Life Insurance, Aluminum Corporation of China, PetroChina, and Sinopec Shanghai Petrochemical Company. They voluntarily are choosing to delist after the SEC flagged these companies in May as not meeting U.S. auditing standards for publicly traded companies. The fact that these Chinese state-owned companies are voluntarily delisting could be a bad sign that the Chinese government will prevent many major Chinese companies from sharing the information U.S. regulators are requiring, which would lead to them being delisted. This could lead to major Chinese tech stocks like Alibaba, JD.com, and others being delisted if China's government determines that these companies are too important to China's national security interests for them to share this information with U.S. regulators. It's very possible that this may be why Ray Dalio sold all of his Alibaba stock, if he believes that these stocks may ultimately either be delisted or voluntarily delist like some Chinese stocks have already done. Another possible reason Ray Dalio might have sold all of his Alibaba stock is that China's economy is slowing down very quickly, with recent economic data being very weak and coming in below forecasts. Reuters reported that industrial output in China grew 3.8% in July from a year earlier, according to the National Bureau of Statistics, which was below the 3.9% expansion they had in June and the 4.6% increase that was expected by analysts in a Reuters poll. And China's retail sales, which only just returned to growth in June, rose 2.7% from a year ago, which missed the consensus forecast for 5% growth. Analysts are worried that the recovery China's economy was seeing was just a temporary boost that came from reopening from lockdowns in some cities. China's continued zero-tolerance policy for COVID cases has led to many continued lockdowns, which has hurt the country's economy and manufacturing. Just earlier this year, the commercial hub of Shanghai had a 2-month lockdown, and other cities have experienced similar temporary lockdowns when cases are detected, which has slowed consumer activity, confidence, and manufacturing. To make matters worse for Chinese stocks, China's economy is also suffering from a rapidly deteriorating property and real estate sector. China's property sector accounts for around a third of the country's GDP, and housing makes up nearly 70% of Chinese households' wealth, and almost 30% of bank loans are property-related for the country. So the worsening property market is a major risk for China's economy, and potentially for Chinese stocks like Alibaba, if the slowdown continues to affect consumer spending and confidence. The property crisis has been brewing in the country as highly leveraged and indebted property developers continued to take on debt from investors to build real estate in the country. But there has not been enough demand and cash flow to sustain these property developers in recent times. This led to Evergrande, a Chinese real estate developer with around 200,000 employees, to default on its debt. This has led to a serious cash crunch for Chinese property developers, and many others have defaulted on their debt since Evergrande first defaulted. These property developers are now unable to finish existing real estate projects they already sold to buyers, because they have run out of cash to continue their operations. Since existing projects aren't being finished, and Chinese citizens know that these property developers are at risk of failing, demand for property and real estate has been collapsing, and existing buyers are threatening to not pay their mortgages unless the properties they pre-purchased are finished. This in turn has been hurting Chinese banks, who gave loans to property developers that these developers can now no longer pay. And the banks also gave mortgages to citizens that are now refusing to make mortgage payments on the unfinished projects they bought from these property developers. So banks loaned to both parties and are now struggling to be paid by either the property developers or the people that bought these properties. The property crisis in China isn't getting any better either, as the situation continued to worsen in July. Property investment tumbled 12.3%, the fastest rate this year, while the drop in new sales deepened to 28.9%. To make matters even worse, China's unemployment is 5.4%, but the unemployment rate for young Chinese people aged 16 to 24 hit a new high in July. The official rate of 19.9%, released by China's National Bureau of Statistics, is a shockingly high number and means that 1 in 5 young Chinese people are unemployed. All of this is causing economists to become more pessimistic about China's economy. Bloomberg reported that Goldman Sachs lowered its projection for Chinese gross domestic product growth to 3% from 3.3%. That's below the 3.8% consensus in a Bloomberg survey of economists, and is significantly below the Chinese government's original target of around 5.5% growth that was set for the year. The economic problems China is facing right now are widespread and could continue to deteriorate if the property crisis worsens like it has been. This may have influenced Ray Dalio's decision to sell Alibaba stock and many other Chinese tech stocks in his portfolio. Another major thing that's become very clear is that China's government regulators have been very critical of Alibaba and other Chinese tech companies in recent times. Alibaba has been facing anti-monopoly scrutiny and has received multiple fines from the Chinese government. It faced a record $2.8 billion fine from Chinese regulators just last year, and was fined again just as recently as last month for anti-monopoly reasons. The increased scrutiny from China's government and the business changes they are requiring Alibaba and other tech companies to make has been weighing on Alibaba's stock, and may be another reason that could have influenced Ray Dalio's decision to sell Alibaba. Because of the delisting risk, China's economic issues, and the increased regulatory scrutiny, there are a lot of negative factors currently facing Alibaba's stock and other Chinese tech stocks. These increasing risks and the uncertainty surrounding Alibaba stock may have been what ultimately prompted Ray Dalio to sell all of his Alibaba stake and other Chinese tech stocks that he had. But be sure to let me know your thoughts on Alibaba's stock and Ray Dalio's recent decision to sell it in the comments below. And be sure to subscribe to the channel for more finance and investing content. Thanks.